Hi everyone, welcome back to this week's economic and market update for the week of Monday, April 24th, 2023. I'm Casey O'Rourke with Fross and Fross Wealth Management. Before we get started, please take a moment to view those disclosures attached within the email or go to our website at www.frossandfross.com. And please remember that anything mentioned in today's commentary should not be taken as a recommendation. So last week marked the 6 months point since the S&P 500 dropped below 3,600. Inflation reached a 40-year high, and the yield on the 10-year Treasury bonds rose approximately 4.25%. Although they remain unpredictable, both the stock and bond markets have rebounded. Inflation is slowly declining, and bond yields appear to have peaked and begun to move lower. With that said, now seems like as good a time as any to take a look at what is supporting this rebound and what might be holding it back. First is the economy. Believe it or not, economic activity has been better than expected, which means we are still in an expansion territory. In fact, the U.S. GDP grew 2.6% in the fourth quarter of 2022 and is expected to be at approximately 2.5% for the first quarter of 2023. The main reason behind this is the continued health of the job market, which in turn supports consumer spending. On the downside, job openings are trending slightly lower with uncertainty over banking. Lending has become even tighter, and that could cause economic activity to slow, and yet remains to be seen. With core inflation hitting its peak 6 months ago, we are seeing a slow decline in energy prices. As a result, headline inflation and housing prices are beginning to level. With the Fed's aggressive stance toward rate hikes, we expect to see the housing market continue to cool and Fed hikes to be discontinued in the near future. While this disinflation process is underway, we do need to remember that there is a lag between monetary policy changes and their effect on the economy. This means that the Fed and consumers alike are in a holding pattern and a wait-and-see period while we look for signs of economic impact. What's more is that inflation in the services sector is far more persistent than expected, and we aren't seeing relief just yet. That, coupled with the potential for 2 more rate cuts, may mean that there'll be more volatility in the near future. And then there's a matter of corporate profits, where the focus is laser sharp on the banking industry based on recent stressors. I'm sure you've all seen that in the news. As we enter the earnings season, we haven't seen the expected significant strain on banks, and as a result, the financial services sector, while at the bottom of the performance list, has outperformed the broader market. S&P 500 companies are showing positive revenue growth with demand for travel and services as key drivers. On the flip side, analysts have lowered earnings estimates for 2023 and are now estimating no earnings growth for the year in the S&P 500. We believe this is indicative of a slowdown in overall economic growth, although we are seeing analysts calling for an uptick in earnings towards the end of the fourth quarter and into 2024. So hopefully that's a good sign. Well, that's all we have for today. Again, I'm Casey O'Rourke here with Fross and Fross Wealth Management. We hope you have a wonderful week ahead. And as always, please reach out with any questions or concerns. Thanks for joining us. Bye.